Welcome to our financial analysis of Credit Suisse. Today, we'll delve into the company's stock price, CDS, and the recent events that have impacted its financial standing. On March 15, 2023, Credit Suisse's CDS reached their all-time highs, with the 1-year at almost 800 basis points. The stock price, already in a downtrend since the beginning of 2022, is sharply declining these days, losing more than 20% week-to-date, 30% year-to-date, and more than 75% since 2022, January 1st. In this chart, we quickly notice 3 recent spikes in the 1-year CDS time series, moments in which the stock price declined and cost insuring against Credit Suisse's default increased. 2022, October 7th, in the last week of September, started to spread some rumors about Credit Suisse's immediate need to raise capital. Some say through the split of the investment bank division, others withdrawing from the U.S. market, selling LATAM ex-Brazil wealth unit, etc. For fiscal year 2021, Credit Suisse reported a huge loss of around $1.8 billion, and many scandals impacted the company during the last few years. On this date, the fear of Credit Suisse's default reaches its relative high. 2022, December 9th, the new CEO corner during the Q3 earning call of the end of October, where they reported a quarterly loss of more than $4 billion, announced a new plan to change routes and come back to make money. He confirmed the intention to spin off the investment bank division, around the 30% of their revenue, and focus on the wealth management division, currently at 33%, cutting thousands of jobs during the next 3 years and raising some capital from Saudi Arabia. At the same time, the CEO confirmed the immediate future will be tough because those changes need time to be effective. And also for 2023, huge losses are expected. But the outflow process has already started, and neither this announcement can stop it. 2023, March 15th. At the end of the last week, we witnessed the SVB, Silicon Valley Bank case. And at the beginning of this week, the bank sector crisis spread also in Europe, with all banks under pressure. Considering its recent past, Credit Suisse has been addressed as one of the riskiest banks in Europe. The bank, 1 month before, reported its full annual data and, among other bad data, a net income of around $7.5 billion, the biggest loss since the financial crisis in 2008. On March 14th, the company's management published the results of the assessment made of their internal control system over the last financial reports. They conclude that their internal control system was not effective and not able to identify and analyze risks. If this is not enough, above-mentioned Saudi Arabia's investors have made it clear they won't increase their stake in Credit Suisse. They already are at 10% of the capital, and the possibility to obtain state aid is not a topic, according to the CEO. That's why at this date, we see a record high in CDS cost. Many traders are betting on the Credit Suisse default. The short answer is no, because there are huge differences between the two cases. The size is quite different. Excluding the higher market cap of SVB, here you can find our post about SVB. Credit Suisse is bigger in terms of total assets and total deposits. Moreover, the change in deposit data is impressive for Credit Suisse. More than $174 billion went out of the bank in 2022, an astonishing minus 40% in deposits compared to the previous year. All values are in million US dollar. Market data as of February 28th and reported data from the latest full annual report, 31/12/2022 for both. The core business is different, while SVB core business is pure banking, collecting money from surplus agents and transferring them to the deficit agents, showing no diversification even among their client types, mainly companies located in California or Massachusetts. Credit Suisse is a so-called universal bank, being well diversified among several industries. Wealth management, 33%, investment banking, 30%, banking, mainly in Switzerland, and it represents around the 30% of the revenues, and asset management, 8%. Credit Suisse diversification is not only among industries, but also among regions. SVB is concentrated in US, while Credit Suisse generates 40% of its revenue in US, and the remaining part is distributed among Switzerland, 36%, EMA, 12%, and Asia-Pacific region, 11%. Despite these differences, there's one big thing in common among them, which is probably also in many other financial institutions. The governance is weak, internal control systems are inefficient, and external control systems are even worse because of conflict of interests. It seems that 2008 has taught us nothing. Who should be in charge of controlling is not doing it, or has no incentives to do that in the proper way. Credit Suisse is facing a tough period that started some years ago, and today, in a period where banks are under attack, the fear of default comes back. By the way, Credit Suisse just raised new capital last year, and its liquidity coverage ratios, even if they are declining, are well above 100, indicating a non-dangerous situation. But as we have seen, internal controls are not effective, and we do not know if they are properly managing their risks or if they are neglecting anything. If you like this post, feel free to share it, and if you are not part of the community yet, subscribe now to not miss any posts. Disclosure, this is not a financial recommendation. We provide our view, but you have to perform your own research to create your investment idea.